Bismillah, welcome back to Trade and Wait. Going to review price action on the ES for the previous 2 weeks. That's where we left off. The last recording I believe we had was on the 1st of January 2025. And we have these two down close candles. We just want to review price action to see how well we would have performed or how well we did perform, and potentially where we may be headed currently, right? Into this upcoming week, right? One thing that may be beneficial to us is, again, of course, we want to trade in the direction of the higher time frame, aka having a higher time frame bias or trading in the direction of institutional order flow. And this is the triple screen concept that Alexander Elder mentioned in New Trading for a Living. So ideally looking at least two time frames at a time, but you can have three. The high time frame would be the trend. Again, that phrase, trading in the direction of the high time frame bias. Also, looking for the higher time frame draw on liquidity or potential draw on liquidity. That's ideal. So higher time frame is key, and it doesn't really I don't want to say it doesn't really matter on which time frame you consider to be your higher time frame, but you want to be based on your trader identity. Rather, you are looking for day trades, short day trades, swing trades, long, shorts, etc. All of that is part of your identity. Some people don't trade well to the downside. They only trade well to the upside or marginally well to the upside. You may want to just consider asset classes that's giving you opportunities to the upside. Again, it's all based on what are your strengths and identifying your weaknesses and building on your strengths and trying to strengthen up your weaknesses, right? So you want to trade in the direction of the higher time frame. Sometimes, well, in general, the intermediate time frame will be a counter trend trade potential, counter trend trade, and you want to align your, let's say the high time frame is bullish or going higher, potentially going higher. You want to watch the intermediate time frame for pullbacks, for counter trend trades, and then looking for the intermediate time frame and the high time frame to be in alignment with each other. Once that alignment happens, that's when you want to look for your entry, right? One thing I wanted to mention, and this is also from New Trading for a Living from Alexander Elder. One thing he points out is that you want to develop a method of analyzing the market that is, if A happens, then B is likely to happen. I just want to remind myself and everyone else that all trades are based on probability. Nothing is guaranteed. So that leads us to the next idea, which is risk management, developing a money management plan. Your first goal must be long-term survival, aka preserving your capital that you did into the market in or with. And your second goal is a steady growth of capital. And then finally, the third goal would be to make high profits or exponential returns. And that's all part of your goal setting. And he continues, most traders put the third goal first and are unaware that goals 1 and 2 exist. Another point he mentions is be aware that a trader is the weakest link in any trading system, right? You're the most volatile aspect of your trading plan. Now, one thing that I'm working on this week and probably this whole month is the reduction of impulsive trades. And what I mean by impulsive trades is literally taking trades that I don't have a complete plan around or plan period, and also reducing entering trades that I don't have a trade at all for, right? So that's what I'm defining as impulsive trades. That is what I'm working on for the remaining of the month and probably for the remaining of the quarter. That would be the highlight of my of my growth potential is to reduce these impulsive trades. And obviously, the second factor would be to risk appropriately, not risking too much per trade, not thinking in terms of R. Let me reword that so it won't be like in a negative way. Thinking in terms of R would be one of my second goal for this quarter, for the month, rest of the month, as well as the rest of the quarter. So again, not taking or reducing and eliminating impulsive trades and thinking in terms of R, and that includes right, thinking in terms of R, and this thinking in terms of R includes knowing your entry as well as where you will place your protective stop. That's the first part of thinking in terms of R. And then afterwards, you can think in terms of multiples of R. In my case, I use standard deviations utilizing the fibs. One standard deviation, two standard deviations, or any segment thereof in conjunction with swing low, swing highs, or internal range liquidity to external range liquidity. Another point, and this is great, right? He says he recommends going to meetings of Alcohol Anonymous to learn how to accept or avoid losses, or develop your own method for cutting out impulsive trades. Another point he makes is winners think, feel, and act differently than losers, right? Like we vibrate on a whole different frequency, man. Like listen, I can't engage in with you on what matters to you if it's not in alignment with what and who I want to represent me, if that makes sense. Like, to be a winner, you have to do what winners do, or you pretty much stay catching L's, right? That's on you. So you must look within yourself, strip away your illusions, and change your old ways of being, thinking, and acting. Change is hard, but if you want to be a professional trader, you have to work on changing and developing your personality. You literally have to become a whole new person. With that, again, triple screen. You want to have a high time frame alignment for your trade setups. If you do use the intermediate time frame, you're looking for that intermediate time frame to be in alignment with your higher time frame. So if it is going against the high time frame, whatever time frame you determine that is, you want to wait that out and look for like key levels, rather that's PD arrays or support and resistance levels, or waiting for some type of liquidity to be taken out, internal range or external range. And then you can literally look for your setup or your edge on any of these time frames and execute based off of what you see, not what you want. So anyway, I'll erase this and I'll draw it back. So these beige or tan lines delineates the start of a new week. So this is the previous week we want to review, and this is a previous week. This is 2 weeks ago, and this is the previous week, right? Let's see something. Right. All right. Okay, so this is the weekly time frame and the 4-hour time frame. I skipped the daily, right? And one of the points here is to look at how does the weekly PD arrays or the weekly levels, how they correspond and offer potential setups on the 4-hour chart. We can go a step further and put the 15-minute time frame here. Problem is it won't capture as effective. Let's take this off. All right, so all right, so we've been the other thing is I want to make this video as short as possible because I know everyone's attention span is pretty short. And, you know, I don't want to be a source of distraction, but an asset, right? So what I highlighted initially was the inverted fair value gap on the weekly time frame here, and I incorporated the volume imbalance. I'm going to highlight the volume imbalance just so you can see it, and then I'll delete it. How about that, right? But you can still see if you didn't, if your PD array that you focus on is or are volume imbalances, then stick with that. If it is fair value gaps, inverted fair value gaps, stick with that. If it's order blocks, stick with that. Or any conjunction of those PD arrays. But you want to be as consistent as possible with your system, with what you have at your disposal to identify edge and or width. All right, so I'm gonna take that back off. There's another, we were also highlighting this fair value gap, which potentially will become an inverted fair value gap. So I'm gonna paint that gray because price currently is trading below it. May gap back up and may gap down into this, taking out this swing low or this fair value gap. All right, so for me, internal range liquidity. So you have external range taken out here when price so you have internal range liquidity, external range liquidity taken out here. So you have a run on stops. And in this case, you don't have a break in market structure until here on this candle, on that candle here. That would be your break in market structure, your market structure shift. Then you have the retrace, right, into this order block, right? So that's also, right? So you don't have a market structure shift until down here, but it's still present. The same setup that I highlighted before. Rule number one, wait for run on stops. Rule number two, wait for a market structure shift. Rule number three, a retracement above 50% of the price leg that caused a market structure shift into an inefficiency, right? And then look for your entry there. Look for inefficiency or PD array. So I'm gonna take that out. So, all right, so that's your run on stops. This is your market structure shift. Price running below these three up close candles. This is an order block, all three of them, right? And you could have utilized this first one here for the initial short, or you can just say, hey, price ran this resistance level, so this is a false breakout. Say price ran above this level and wasn't not able to hold above it, right? You can do that as well. I make that purple, so you can see like the order block here. There's this single candle. Once price broke below that, is a change in the state of delivery. So you could have caught this short here. I'm like way off target, but what I mean by off target, I'm like way off of these previous 2 weeks, right? Because you have to go back as far as this is a weekly time frame, so you can't just look at these 2-3 candles by themselves alone. You have to see what's going on in order for you to tell the story, right? So this is that order block, the candles close and the open in price only. And you can see here, this would be a, I'm not going to utilize this 15-minute time frame right now. So I'm gonna take it back off. It's just kind of getting in the way, right? So you had a run on stops. You can see here again, similar situation. Run on stops. You have a break and market structure here and a retracement into a feed array, but that's also going to be your optimal trade entry short as well. And there you go, right? So there's your short, and that's about 3 standard deviations. Drag that back down there. So you got 1 standard deviation here, 2, and you have 3, and that's literally trading back into this at the time a bullish fair value gap, weekly fair value gap. Price held above that level here and push higher. And you got a break in market structure here. Here's a retrace. I think we went over that hidden OT entry, but also this breaker as well. We reviewed that. All right, so we have the break and we have the run on stops, the break and market structure, the retrace here on this candle. So that's three weeks. So that's 1, 2, 3 retrace here. But also there's a PD array that we kind of ignore, I guess. I'm not going to say ignore because we all function differently. But this one here, this level on this candle, this is a right. So price pushed off of a bullish fair value gap, traded back into this inverted fair value gap. But it also, this would have been a bearish fair value gap, a SIBI, sell side imbalance, buy side inefficiency. This candle opened here, ran up, rebalanced. So this is an immediate rebalance. So this is an immediate rebalancing of a price range. And so that's 6107. And let's just see what the high, 6107.5. That's pretty decent. So it rebalanced this price range that would have been a SIBI or sell side imbalance, buy side inefficiency, or a bearish fair value gap. And then it pulled back and closed here. This candle opened here, ran up slightly, right? The manipulation. Where are we here? Open here, pulled up, and then dropped down back into this bullish fair value gap. Pull back up, close here. This one returned back into the inverted fair value gap and then drop back into this inverted. Well, it's still a bullish fair value gap. I'm only calling it an inverted fair value gap because if we look here, you'll see price is below it. And we want to see if price is going to hold below this inverted fair value gap or reclaim it. And if it holds below this inverted fair value gap, we want to see if price is going to either sweep this swing low or trade into, aka trade into this bullish fair value gap. And you can see price reacted to this fair value gap several times. We have 1, 2, 3, 4 contacts being made here. So we want to see if this is the draw on liquidity or if price will hold back above here and potentially take out this swing high. Yeah, so I think that's pretty good. All right, so we have these levels. This is the previous week here, previous 2 weeks back into here. So we can actually go down to the 4 hour here and utilize our 15-minute time frame here, looking for like potential entries based on these high time frame levels. So overall, we would say we were bearish, right? So this is one leg down. So technically, it's like one leg down, pull back, two legs, right? What am I talking about? So it's kind of like, let's see. So one, all right, get that correct. And almost the same exact length. One, pull back two. So A, B, C, D pattern. So that's a measure move. So that's one move, pull back two. That's a measure move objective. That was pretty good, pretty solid. So that's one way of looking at that. Here you have a balanced price range here, technically pulling back into this inverted fair value gap, but also this balanced price range here. Right, so we have that. So there you go. So that's technically another entry. It almost makes you don't even need like these, unless you're doing like day trading or scalping opportunities. This is here, right? Market open somewhere around here. Have a manipulation. So you have accumulation, manipulation, then you got distribution lower. I don't know. Accumulation, right? A's a range is accumulation, typically accumulation phase. London typically makes the lower high of the day. That's either showing the London kill zone or the London close kill zone. In this case, it's the between what was it supposed to be 10 to 12, but it looked like it happened way before that. Anyway, so that's a probabilistic outcomes, and that's also optimal trade entry. So we have a run on buy side, have a break in market structure here, and then we have a retrace above 50% of the level. I'm just throwing stuff out there as discovery, right? So there you go, right? If that didn't make sense with the accumulation, manipulation, then distribution, you have a optimal trade entry chart. That's on the 7th. That would be Tuesday. And it's also the probability that Monday or Tuesday into Wednesday potentially can create the low, the low or the high of the week. In this case, Monday was the high. Breaker market structure with this candle and the retracement. So here's your low risk sell short, and you're looking for a high time frame objective, which is this weekly, either the weekly swing low, maybe the weekly swing low here, or this bullish fair value gap. But it did break through it with some degree of force, so potentially taking out this swing low. Another factor to look at is if you use this range to this range, we are in like a steep discount. We use this range to this range, we are still not above below 50% of the price range. Right now we at 24 minutes. I want to keep this as brief as possible. All right, so yeah, we're still above 50% of this. So ideally, if we are looking for bullish patterns, it will potentially draw into here or into this order block here, or this, like if you don't use order blocks, and you'll say this bullish fair value gap here. So we have a lot of opportunities here, and that's still within the confines of an OTE entry as well. So and here is one, like this opportunity here, you may have missed it, right? This here, because it created relative equal lows as well. So this is also a reason why it became a target as well, to continue breaking below that, take out these relative equal lows or low resistance liquidity. So I drop down here to look for potential setup here, right? And this would be an order block entry for me, right? So you have this bearish fair value gap for the low risk entry, the low risk long. So this was a bearish fair value gap, and you see here on this 2:45 p.m. Candle on Thursday, that price that it traded back into here, but pulled back down into this order block. This order block here, right? And then it broke above this and then used it as support, which just makes it an inverted fair value gap. And you could have targeted the previous, this day's high here, and then you can see it created relative equal highs here and pull back into this tiny little fair value gap here, and then continue higher into an higher time frame PD array. Try to make it as brief as possible, less talking, potentially opening myself up for more mistakes, but such is life. We are looking to grow, to blossom. I didn't say the mantra, I'm gonna say it now. Day by day and in every way, we're getting better and better. Day by day and in every way, we're getting better and better. Day by day and every way, we're getting better and better. Please like, comment, and subscribe. If you have any topics or anything that needs more clarity, then please comment. Let me know. And that's all I have for now. Thank you for watching and listening and engaging. Be well.